And over the last 3 days, the country's focus has been on the performance of the shilling. And with the shilling slipping to levels last seen in 2011, the Central Bank of Kenya has been quick to point out that it was ready to intervene to prop up the local currency. But just what is ailing the local unit? As Adelaide Changole reports, the shilling is besieged with local and international pressure, creating the perfect storm for the downward spiral of the shilling.
Tea, coffee, horticulture and tourism have traditionally been Kenya's key foreign exchange earners. However, declining commodity prices globally and the issuance of travel advisories, which has crippled the country's tourism sector, has dampened these forex inflows. And now the chickens are coming home to roost.
On the agribusiness side, we're not exporting the same number of volume when it comes to things like tea and coffee. And then also international prices for these key commodities are not very favorable currently.
The global dollar strength continues to infiltrate not just the Kenya shilling but the general emerging markets and the frontier markets.
This has created the perfect storm that has seen the shilling depreciate from 86 shillings and 90 cents last year to 93 shillings and 50 cents, levels last seen in 2011 when the shilling hit the historic low of 107 shillings to the dollar.
Generally, the trend is still very bearish, and I think 95 is well in sight by mid-year.
The slide is in line with forecast from the International Monetary Fund, which had previously stated that the shilling was between 5 and 10% overvalued. This would put the true value of the shilling anywhere between 96 and 100 shillings to the dollar.
Current account deficit, which is not narrowing, it's still expanding. If we look at the fiscal deficit, there's also still fiscal deficit when it comes to the balance of the government budget. And then, as we said, the outflow of exports is not volume-wise and value-wise is not increasing.
But unlike in 2011, when the CBK sat out of the melee and watched as the local unit lost value, this time the bank is being proactive. On Tuesday, the bank released a statement saying it was keeping a close eye on the unfolding situation and would use appropriate monetary policy instruments to minimize volatility of the shilling exchange. And today the bank sold 7 billion shillings worth of dollars to support the shilling.
The fact that they've called to know whether banks can take up some dollar, whether there's a genuine need for dollars, so they supply to some banks, then makes most players cautious. Whatever the pressure, however immense it gets, I don't think they'll let it go beyond 100.
If you look at the cover that the CBK has today in terms of foreign currency, it's at close to a 1.5-year high. This is primarily because of the Eurobond sales. So it means that the CBK has more firepower to intervene against the shilling depreciating further.
However, given the IMF's prediction that the shilling was overvalued, is this intervention necessary?
The balancing of the shilling would have happened fairly quickly if we had that strong export base. But because we are a net importer, then there needs to be some other form of intervention to avoid it depreciating.
But given the pressure that will come from the low commodity prices, depressed tourism numbers, a strengthening US dollar, rising US interest rates could lead to capital flight back to the US and higher crude oil prices that should translate to higher fuel prices. Just how far can the CBK go to maintain the shilling at this level?
We have adequate reserves, as a central bank would say, but how sustainable they can keep injecting dollar liquidity in the market without significantly affecting the foreign reserve position is, I think, the big question.
I think the objective now will just be to manage it for a short period of time and hope that any existing current pressures on the shilling will reduce.
Adelaide Changole, KTN Business.